Welcome to the weekly update, where I'll go over the action in the market for the week of February 10th through the 14th, and we'll see how things look for the week of February 18th through the 21st. The market will be closed on Monday, President's Day, and will resume being open on Tuesday, the 18th. Okay, we had an up week. We've been seeing some kind of weakness coming into the market. We're still keeping an eye on that longer term. But at the same time, the trends seem to be holding up. We're looking pretty positive right now. We're not trending though. And that goes all the way over to the short term on the daily charts and the intermediate term on the daily charts. And here on the weekly chart, we're still not trending, but we are looking positive across the board. We're above all the moving averages on the daily side, above the 20, 50, and 200, and we're still looking pretty comfortable being above the moving averages here. So, any kind of weakness, I'll try to point that out in the video, and I'll try to do a comparison with the daily video. Okay, please know that I do videos every day, and they're available on YouTube, on Rumble. You're more than welcome to take those and see if they're of use to you. And now I make those available right as the market closes. I have a program where you get immediate access to the videos as they are prepared. If you want access to that, feel free to check out the program that I have. There's a link below this video that will take you to the website. It's still free for the time being. Also, I just launched a daily as well as weekly newsletter, also free for the time being. I'm looking at about $8 a month, and it comes out every day, of course. That's why I call it the daily video. And then every week, I kind of combine the weekly video with the intermarket analysis video. So there's some weekly and daily charts intermingled in there, at least discussion. What I try to do with these newsletters is I don't inundate you with a lot of charts. I just kind of go through and give a quick explanation of the different areas of the market. And then the charts that are really something that we should notice, then I include those charts in the newsletter. I do make a PDF available below every video that I post. You're welcome to download that and see if that's of use to you. And I do have a program, as I said. Here's a link. This link is also below this video. Feel free to check that out and see if it's something that you would find value in. Also, I update pivot points every day on the community tab. And there is a chart that applies for the whole month, but I update the chart every day with the new bar for that chart. And then there's another chart that I update, and that applies just to that particular day. I actually had somebody say, "You got to stop putting this spam up there." It's like, okay, this is not spam. So, anyway. All right, I do have a private Facebook group. And what I was doing in the private Facebook group, and I can resume doing this, the daily and weekly newsletter. I was making those available as a PDF, but I really haven't seen much interaction with that. But if you want to come into the private Facebook group, you can have contact with me. It's not a very active group. I just post whenever I upload a video and then it's publicly available. But you can always change that if you want to add some activity to the group. And I'm even thinking about just wiping out comments on YouTube and Rumble. I don't get very many comments. I supply an email address in every video that I upload. And a lot of times people feel more comfortable just contacting me that way. It's more private. Not everybody can come in and react, and you get these crazy things going on. And most of the comments that I get are garbage. So I'm kind of playing around with that, just kind of turning off comments altogether. Also, I post both on YouTube and Rumble. I did mention that. Okay, so for the week, we were up 1.47% on above average volume. It's kind of interesting though. When we had the employment situation report come out a week ago, and then CPI came out this week, and then retail sales came out on Friday. These are three big economic reports. We're actually dropping off in volume. Just something to be aware of, not really putting anything positive or negative in it. Just a little bit surprising. Usually those are higher volume days. We are still positive for the most part. Longer term, we're comfortably positive, and I'll show you the charts to back that up. We are seeing interest rates, well, on a week over week basis, they really didn't change. We went back above the 4.5% level with the 10-year yield. Now we're back down under 4.5%. And that is is helping stocks as long as we're under that 4.5% level. And there's talk of geopolitical concerns or maybe something erupting over the weekend having to do with Israel. We'll see what happens with all of that. We're still dealing with earnings season. A lot of companies have now reported that are inside the S&P 500. And then what was kind of surprising is on Friday, we had a weak retail sales report that came out. And that's kind of got the market spooked a little bit, where we had stronger than expected CPI and PPI. And so you take all that together, and the market's a bit concerned about inflation, but it's really strange. On Wednesday, we had CPI come out stronger than expected. The market tanked. PPI came out stronger than expected. It was the strongest up day of the week. And then retail sales comes out weaker than expected, and we end up pretty much flat on the day. So as far as our trend, we're still not trending across all the different time frames right now, but we are positive. So all the major indexes had gains on this week. At least if you go back over the last 5 trading days, just Monday through Friday, the mid caps were the weakest area, but all the other indexes had gains. Mega caps, that's really what's driving the market right now. And that's what has been driving the market. These are the Magnificent Seven stocks, the illustrious 11, well, whatever category you want to come up with. But they have huge market cap. And so they have a real big impact on the indexes. So if Google, Apple, Microsoft, Nvidia, if they're having a good or a bad day, that can really impact the S&P 500, which is a weighted index. So the more weighted stocks, the mega caps, they're going to have more of an impact. Then there was a lot of economic data that came out. There's a lot of news about tariffs, and everything is happening so quickly right now. You've got one side just freaking out, thinking it's the end of the world as we know it. You got the other side saying, "Oh, welcome back, normal world again." And things go back and forth, but it's happening so quickly that it's really difficult to keep up with what's going on, because by the time people start to complain or praise something that's happening, the next thing has already happened. And we've got these confirmations going on. We've got things in the US. You've got Doge and everything. It's really kind of entertaining to watch. And also, Fed Chair Powell, twice a year, he has to testify before Congress. And he did that this past week. He'll do it again over the summer. Really didn't say anything that was all that surprising that the markets didn't already know, and that he hasn't said already. So no real surprises there. There's really no hurry to adjust the policy stance. And then President Trump imposed 25% tariffs on steel and aluminum, which will go into effect March 12th, with Australia possibly getting a pass on that. Also, there's a reciprocal tariff plan saying, okay, you put a tariff on us at 10%, we're going to put a tariff on you at 10%. And if there are already tariffs between us, we're going to make them equal. And it's seen as less economically provocative as feared. The tariffs won't be applied until April 1st, April Fool's Day at the earliest, and at that time it'll be applied on a case-by-case basis. Okay, and then the economic reports, as I said, we were stronger than expected for CPI and PPI, but weaker than expected for retail sales. Interest rates were down one tick here. We were at 4.49% a week ago. We closed at 4.48%, but it was a wild ride in between. And the dollar has been going down, which probably is also giving some support to stocks. So we had the Dow up 0.5%, the Nasdaq up 2.6%, the S&P up 1.5%, and the Russell was unchanged. During the 5 trading days, it was actually negative. We're keeping an eye on this. I've been looking at this chart. I go over it every week just to see if there's still a connection between 1966 to 1982, where the blue line here, this is what we generally have been seeing as inflation has been coming down. It topped out in June of 2022. It's been coming down, but now they call it sticky inflation because it's not coming down as much as the market had hoped. The Fed wants to get down to 2% into that area. So we're just wondering, are we going to go back up here? And the reason I bring this up in a bigger picture context is we had a real scary, in fact, I lived through this. I was growing up at this time. It's called stagflation, just really, really high inflation, but no economic growth. That could happen Now, we don't know if it's going to happen or not. You've got people that say they think they know what's going to happen or not. We just watch the data and just evaluate things as they develop. Also, we're above that 4.02% level with the 10-year yield, according to RenMac. This was posted a long time ago, too, based on some research they did. That when we get above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. And yeah, the companies are reporting their earnings, and a lot of them are beating their estimates. But in the bigger picture, the growth is slowing down, and it could be because of this rise in interest rates. Now, this was updated a week ago, so we won't get it again until the beginning of March, but these are the long-term, 6 months or longer unemployed folks here. And then I'm not doing the Isabel Net blog charts this time. Um, I have an opportunity to record this video earlier than usual, and those charts haven't updated yet. What we'll probably see is what we've been seeing before is this up and to the right with earnings estimates, and that justifies stock prices going up. But they're slowing down a little bit. They're not as high as they used to be. Then FactSet, they're kind of the authoritarian website, or authoritative, I should say, when it comes to earnings. And this is just the update. As of Friday, 77% of the S&P 500 companies have reported. And of those, 76 of those 77% are above estimates. And then when you take it all together, putting all the companies in aggregate, we're 7.3% above estimates. Not as high as we were before, but still a pretty healthy number. And then the highest number of when they do earnings calls, who's saying tariffs in these earnings report conference calls that they do? And it's really picking up here. Tariffs, 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 where it really wasn't talked about all that much. Notice the last time it was talked about? Yeah, it was Trump 1.0. Now we're dealing with Trump 2.0. And so there's a lot more tariffs that are being talked about here. And this also just compares the different periods. All right, so this is the intraday chart, and we have been seeing some more positive action intraday. I follow a 10-minute chart here. If it's green, it's up. If it's red, it's down. Yeah, Monday and Tuesday, not all that much. There was some anticipation ahead of CPI. Well, it came in hot, so we gapped lower, but we set the low right at the open in Wednesday's session and then clawed our way back. So we opened down here, we closed up here. That's pretty good intraday action. Yeah, we were still down on the day, and it still affects our end of day charts. But to see this action coming up at the low right at the open, because it's the amateurs who open the market, it's the professionals who close the market. And we saw a nice little run up from that. And then that continued on Thursday. Now, PPI came in stronger than expected too, but there was some justification to say, oh, everything's fine. So we're just going to continue to go up here. And then Friday, we were pretty much flat. All right, so this is just the 5 trading days. How did the indexes do? We had the mid caps and the small caps down. Now, if you go Friday over Friday, the mid caps were unchanged, as were the small caps. But going back to the beginning of the year, all of the indexes are positive with the NYSE in first place. And that's rather encouraging. This is a broad market index, and to see it doing that well is rather encouraging. The different sectors, the S&P is broken down into 11 sectors, and we follow these because what's doing good, what's doing bad can give us some clues as to, okay, what's the overall character of the market right now. And since we had an up week, I sort it from what was up the most. And we had the tech sector. And this is a growth area. And when the tech sector does well, the stock market does well, followed by communication, another growth area that did well. Materials, which have been getting hammered a lot lately, they were up. Energy, the areas that were down. Now, the financial sector, it was virtually unchanged, but it's another area that we keep an eye on to see, okay, is there anything weird happening there? That's what happened back in late 2007 into 2008. Nope, it's still holding up for the most part. And I go through that in the daily videos. I also talk about it in the intermarket analysis video. And then healthcare was down as well. That's more of a defensive area. So this is looking fairly healthy for right now. And then what we do over on the right-hand side is this is a scooter score. The higher the score, the better looking that particular sector. When you're in the 90s, that's looking pretty good. And we have communication and the financial sector still looking good. Even though it had a down week, the sector is still looking strong. And discretionary, which has been getting hit lately. Tesla's been getting hammered, and they're in discretionary, as is Amazon. But when they're really strong, they're in the 90s. Then we drop down into the 80s and 70s, which is where tech is. Energy and healthcare, these are more defensive areas. Those are the weakest sectors, but they, at least energy saw some different areas saw improvements this past week. This just looks at the 5 trading days where we had communication, tech, and materials showing some improvements. Staples were up a little bit. They've been getting hammered too. That's more of a defensive area. And then healthcare over here performed the worst. Then going back to the beginning of the year, we have communication, financials, also materials coming on a little bit stronger. Healthcare is actually positive year to date, or discretionary. Now, last summer when we had that end of the world day, a couple of days after that, that's when discretionary really started to perform good, and it's been the best performing sector. Not doing all that great in 2025, but if you take a bigger picture look, it has been performing quite well. Staples are also down. That's more defensive. Tech is also down year to date, according to how it's measured here. Then we look at relative rotation and what is happening here. Remember back to your geometry class where the green area, that's the plus plus. When you look at the x-axis and the y-axis, these are the strongest areas. And yeah, we're drifting back, but this goes over the last year with discretionary. Had been strong. It's seeing some weakness now. Communication is one of the stronger areas, and we're seeing tech coming on a little bit here. But you see over here, over the last year, this is healthcare. Still negative. Sector isn't looking all that great, but the price action has been a little bit better over the last year. Then this looks at it more in a table type format here where we have tech, communication. These are growth areas. They're green. Down at the bottom, we have healthcare, which is improving. The yellow areas are more neutral, financials and discretionary. Again, we want financials to do well. We want discretionary to do well. And then you have the other areas that are a little bit more negative. Then we just look at the different indexes. The NASDAQ 100 is still looking the strongest. That has the mega cap stocks in there, the Magnificent Seven, Illustrious 11, and also the S&P 100 has been improving. And actually, we've been watching that because on a shorter term basis, the S&P 100 has been underperforming the S&P 500. And the S&P 100 are the biggest stocks that make up the S&P 500. And then here's the S&P, which is showing some improvement here. And then the other indexes, which are still showing some weakness. Here's more of a table format here with the S&P 100 and NASDAQ 100. The big stocks, they're the ones that are still doing the best, with the S&P 500 showing some improvement. Now, this is over the last year, not just the last week. So this is bigger picture. Sentiment, we did come into the neutral area and then we started to drop back down. So we're into the negative. I call it negative, they call it fear. And this shows you where we came right about up to this 50 level. We have not been able to get above that. So sentiment is still negative overall. It had looked like it was starting to improve, but it's still dropping below 50. The active asset managers, nothing real crazy. When they get above this red line or below this blue line, that's when we really take note of this. The latest reading for the active asset managers are at 75.62. Not extreme right now. They're confused like a lot of the market is currently. And we're actually coming down a bit here with the VIX. And we're under 20, so that's positive, and we're coming down here with the line chart, which is the closing value, as well as the bar chart. That's the open, high, low, and close for the week. This is also looking positive. The black line is still going down. That means that the tech sector is outperforming cash. And the RIDEX bear bull ratio, folks are still quite bullish here. When we really go down, you'll see this spike. We're actually getting a very low reading right now. And the individual investors, though, they have actually dropped negative. The latest survey came out under zero. We were already below zero. It dropped further, and the 50-period moving average is rolling over as well. So they're turning a little bit more negative on the market. The Ulcer Index, this is another fear gauge, and we're still below the moving average. We're also below the moving average on the daily chart. Not seeing any real concerns here. This is the spread between risky and not as risky bonds. It's a little easier to see this way. middle area, it's an inverted chart of what I just showed you, but it's matched up with the S&P and an inverted version of the VIX. And when we get really high readings like this, that means there's not a lot of fear because it goes the opposite of how, if this, anyway, just hopefully that makes sense. Okay, then we look at the VIX and a 3-month average of the VIX and do a ratio, just kind of chopping around right now, not really showing any real conviction. We're still declining with our long-term moving average of the equity put call ratio, and that's longer term positive. This is just showing here the Chicago national financial conditions were under the black line. So we're looking okay here. The latest reading from GDP now, it did drop off. Okay, came down a little bit. That could be in response to retail sales, but this isn't updated until next week. But we're coming in a little bit over 2%. Not strong growth, but it's growth nonetheless, where we're seeing it about 2.5% to about 1 2/3% or so with the different forecasts. Also looking positive across the board here. We're been getting the numbers. We got the first number for the fourth quarter of 2024. Now we're starting to project, okay, what is it going to be for the first quarter of 2025? This was also updated a week ago. We're under this red line, 0.37. If we get above the red line, that can mean that we might go into a recession. And then the smooth US recession probability still just barely above the black line. And then the Brave Butters Kelly leading index, it is coming down. So according to these charts, no real concerns about a recession. And we're also seeing that in the market as well. As far as inflation, it did get adjusted this past week with CPI coming out. It's like, oh, stronger than expected here. And then the core PCE, that really didn't change from, what was that, Wednesday to Friday, but that was bumped up as well. So we are seeing an uptick in inflation. As far as the Fed, 96% chance that when they meet on March 19th, they will leave rates where they're at right now. And the market's pretty much locked into that. This dark blue is the latest reading. Then we go a day ago, a week ago, and a month ago. And we're just becoming more convinced that's what will happen. Then we look out to the May 7th meeting, 84.1% chance that they'll leave rates unchanged at that meeting as well, and becoming more convinced that that is what may actually happen. And then the Fed balance sheet, which has been declining for the most part here. This is a year-over-year change. It has been going up just a little bit when you compare it that way. And the overnight reverse repurchase agreements, not really showing anything that's causing any concern right now. Okay, so we're still looking good with our advanced decline line. Based on price and volume, we're above advancing moving averages. Seeing an improvement here with the new highs minus the new lows. And we're also looking okay on the daily chart. We're seeing more new highs than new lows, and that's what we're seeing here. But it would be nice if we could get back above this 4-week moving average, but we're still declining with the 10-week moving average. And it's not so much that we're seeing an expansion of the new lows. It's more of a contraction of the new highs, which is turning these moving averages down. In the short term, a 19-week advanced decline ratio, we're still dropping below zero, but we're still above zero with the 39-week advanced decline ratio. Here's the trend where we're still below 20 and declining. That means we're in a non-trending environment that's still continuing to get weaker because it's below its moving average. But we default to positive because the green line is above the red line. And that's pretty close to what we're seeing on the daily charts, both in the short and intermediate term. The Arun, not really changing on the daily chart at all, but it is positive, and we're positive here. This is the green area, that's buyers. The red areas, that's sellers. And then the oscillator on the bottom just measures the difference between the two. And when it's above zero, that means it's positive, even though we're seeing a bit of an increase in sellers and a bit of a decrease in buyers. Mass index not generating a signal. We had been generating one on the daily chart, but then the trigger happened and we've waited a couple of weeks now and nothing happened with that. Okay, here's the daily chart showing how we're just a little bit below average here in Friday's session. We're still well above the 50-day moving average. We did not set an all-time high on Friday, but we're really close to that. So looking longer term, this is a 50-week simple moving average, and then prices going up, the red line's going up, and prices above the red line. That is positive. Then I use a moving average crossover here with a 13-week moving average in blue and a 50-week moving average in red. We're above the 13-week and all the lines are going up and prices above both lines. That is positive. Pivot points, we're kind of in between right now. So we're not really dealing with any of these. If we go down, we'll be watching this pivot point. If we go up, we'll be watching this R1 pivot point as resistance. This I've been talking about pretty much in every daily video going back to December because this is a trend channel and we hit the upper end of this and we have not been able to get above it. Can we break above that? No, not to this point, but maybe that's still to come very soon. All right, then I have 3 smart money indicators, and that's where we're seeing a real battle right now. If you look at a lot of our primary indicators on the daily side, a lot of them are negative. But if you look at the smart money indicators, they're looking positive. In fact, maybe too positive. They pulled back a bit in Friday's session. And that's what we try to balance here. The smart money, these are the folks that really control the market. These are the institutions. I mean, the huge that have virtually unlimited money, and they can drive the market up or down. And what I try to do is figure out what is the smart money doing and then just do what they're doing. Well, this is a smart money indicator because it uses price and volume together. And we're still looking positive here. We're also looking positive on the daily chart, maybe extreme positive. We're getting kind of far away from the moving average on the daily chart. The chicken money flow looking a little better here with the red line going up. We're also looking pretty extreme positive on the daily chart. And we're looking better here with the chicken oscillator. We've actually gone above this red line on the daily chart and are coming down, and that's actually turned negative because it's dropping below its moving average. So we'll be keeping an eye on that. But here on the weekly chart, it's still looking positive. The vortex is another primary indicator. It's pretty much what we're seeing on the daily side, going up with the green line. Well, the green line's going up. We're going down with the red line right now on the daily chart, where it's coming up a little bit here on the weekly chart. And coming right back up to the midpoint here with the McClellan oscillator. So that's showing some improvement. We're above 0 here with the summation index based on price and volume. But you can see they're getting a little bit choppy lately. The bullish percent index, it's still negative on the daily side. And it's somewhat negative here because it's been going down. And there's a moving average that I use on the daily chart. And when we're below that moving average, we're negative. When we're above the moving average, we're positive. So this is still positive in and of itself because it's above 50. And we're seeing that on the daily side too. But it would be nice if this could turn and go back up to turn positive. Swenlin trading oscillator looking better and improving on the daily side, also showing some improvement here based on price and volume. And I'm noticing this on the daily charts too. We're actually seeing volume preceding price right now. And that could be positive. If you see volume doing better than price, usually that, not usually, but oftentimes it can lead price higher. And then we look at the PMO. This is momentum, still looking more negative here. And we're rolling over and turning more negative on the daily side as well because we haven't been trending. We've just been chopping around, not really doing all that much. And these are the studies that go along with the PMO. A little bit of a tick up here with the PMOs that are rising. And we're seeing that on the daily side. We're also seeing a decline on the daily side with the buy signals, as well as right here. And we're flattening out with the PMOs that are above 0. We see a real strong connection between the daily studies and the weekly studies. Quite often they're showing about the same thing. Nothing here right now. This is the percent B. We didn't close above or below the upper or lower Bollinger Band. This is the momentum where we're looking more negative here with the slope. We're also with the TSI. These are short-term oscillators, also turning more negative in the intermediate term, and we're looking more negative here in the long term. Now, on the daily side, we're flat with the TSI. We're declining with the slope. We're seeing some weakness, but possibly a little bit of improvement with the up week that we had with the MACD, PMO, and PPO, where we're positive but starting to roll over here with the longer-term oscillators. Copy curve is negative on the daily chart and here on the weekly chart. This is another momentum oscillator. We're coming up, but still below 50 with the money flow. That's negative, but we're positive here with the force index. We're above 0 in green, and this is 1 week to the next. We had an up week, so we are above 0 here. And we're coming back up about to this red line when we go back 50 weeks. So this is showing that longer term things are still holding up. Then the RSI, we're crossing above the midpoint. So that's showing some improvement. We're getting an extreme reading here with the Williams percent R. That's showing good longer term momentum, still continues to the upside. We're above 50 and going up with the RSI based on 14 weeks. Ultimate oscillator is above 50. That's positive. And a long-term oscillator, the special K, is still above the red line. That is positive. And you notice how we came right down to this 10-week moving average? That was about the low we set, and that's right at about 6,000. That's where we opened on Wednesday. We just barely came just a point or two above 6,000 before we turned and started to go back up. So these support levels are holding for right now. And looking at different ways to look at the trend here, we're positive with the Heiken Ashi with open candles. We're black and pointing up with the Kegi chart. We're positive with the Renko chart with open blocks. And we're positive with the three-line break. And we had 3 new X's drawn in here. There was enough of an up move to get us up to at least this previous high. So that is looking more positive on the point and figure chart. And we're declining, but still above zero with the ease of movement. We just switched over to positive on the daily side. And we're seeing a little bit of a drop off here with our long-term momentum, a little bit of an improvement in the intermediate term, and a bit of an improvement in the short term. And we're still positive. Actually, we've gone back to positive with the Elder's Impulse system for the S&P. We're neutral. Now we're back to green, which is positive. And we did switch back over to positive on the daily parabolic SAR chart. And we're positive here on the weekly parabolic SAR chart. So those are confirming each other. And let's see, this is shorter term. The only thing that's negative right now are the mid caps in the short term. And bonds have switched back to being in an uptrend in the short term. And the dollar is in a downtrend short term. This looks at the S&P really, really close to that previous all-time high, lagging behind with the mid caps and the small caps. The Dow in an uptrend above both moving averages. The NASDAQ in an uptrend above both moving averages. Same thing can be said with the NASDAQ 100, looking pretty solid there. But the mid caps lagging below the 13-week moving average, as are the small caps. The NYSE looking really good here, above both moving averages. This is a daily chart of the Wilshire, looking pretty solid here. The FANG index set an all-time high on Friday. And so that's looking solid. These are the mega caps. All stocks looking really good. These are US and world stocks. The FANG, didn't I just show that? I think I hit the wrong button. FANG index all-time high. All stocks, ARC, still looking good. Had an up week, up 6.79%, but a long ways to go to be the darling that it once was. And the banks are holding up here with the longer term chart. We're looking good with the RSI, looking good based on price. We're trying to get back to positive with the momentum. Seasonality, dealing with February. The first half of February tends to be okay. The second half of February can often not be so good. Now, we only use seasonality to just kind of get an idea. We don't try to say that it's going to happen exactly the same way. And here's the Dow, close to its all-time high, but lagging with the transports and lagging with the utilities. Then the CRB index, these are commodities, and this going up is kind of causing some concern with the market now, but it's in a longer-term uptrend. Oil, though, has been staying down around the low 70s. We'll see if there's something geopolitical that happens in the Middle East. We'll see if that spikes up next week. The dollar is still in an uptrend, but it's pulling back and falling underneath its 13-week moving average. Copper in an uptrend longer term. It's still in a downtrend on the daily charts. We'll see if it shows some improvement going forward. Gold in an uptrend, just coming off of an all-time high. Silver not at an all-time high, but still in an uptrend. Then looking at the total bond ETF, these are bonds based on price. We came down to the 50-week moving average, and we've been able to bounce above that and get above the 13-week. If we can keep going up with this, that would really help interest rates to go down. Because when bond prices go up, interest rates fall. When interest rates fall in this kind of an environment that we're in, that at least on a short-term basis can help stocks. Now, there are periods of time when the economy is really doing well and interest rates are going up because the economy is doing well, and stocks can go up at the same time. This is one of those periods where the market's okay with interest rates going up until they get above that 4.5% level. That's where we started to run into trouble. But that could change and go away at any time. This is a long-term chart of a stock to bond ratio, still showing how stocks are outperforming. This is a daily chart of the yields where we have been coming down, then we started to spike back up, and now we're coming back down again. And this is internationally. We want to keep an eye on this, and I've been harping on this in the daily videos. The red line is the 10-year yield in Japan. Last summer, when we got up over 1%, that's when we had the end of the world day. Then we fell down after that. Well, interest rates are going back up now. Is that going to matter? Is the Japanese market, are the Japanese markets going to freak out and cause a problem similar to what we saw last summer? We're just keeping an eye on this. Then some relative studies. We have gold performing best year to date, followed by stocks. And then bonds, believe it or not, woohoo, they're actually positive for right now. And the dollar, even though it's in an uptrend and did really well in late 2024, it hasn't been doing all that great in 2025. Then a ratio between the Nasdaq 100 and the S&P in a good solid environment, that's what we'll see here is the Nasdaq 100 outperforming the S&P, but they're both doing quite well. The S&P 100 improving after it had been falling back when you compare it to the S&P 500. Growth is outperforming value. That's what you see in a solid positive market. Gold and the S&P just kind of chopping along sideways. Bonds are still underperforming stocks longer term. And we're going back up now as gold is outperforming the dollar. The dollar's been seeing some weakness as gold's been going back up. Energy to tech still showing how energy is underperforming tech. Discretionary still outperforming staples even though it has been pulling back. Low volatility stocks. If the market was really getting ready for a severe downturn, this ratio would be going up, not down. And then small caps to tech shows how the small caps continue to underperform the tech sector. Then longer term, looking at the NYSE breadth thrust, not really anything all that substantial here. No new ZWAG NYSE breadth thrust for the time being. Longer term, still looking good. Going back to the 1987 crash, when I'm looking at the weekly chart of the S&P, still having a full-on buy signal with the Zohorchak method. And not really showing all that much improvement here. We were looking a little bit better when we look at a 50-period moving average of the new highs, new lows for the S&P. Also, but looking a little better here. We're going back up when we look at a 50-period moving average of the NYSE new highs minus the new lows. So the broader market's doing a little bit better than the S&P 500 in that regard. We're still looking positive here with the weekly chart of the NASDAQ 100. Still above this red line when we look at the NASDAQ 100 versus the Dow. And still going up here above the blue line when we look at the NASDAQ 100 to the small caps. And just keeping an eye on this. This is the 3-month yield, just to see if anything really weird is happening. And kind of not really showing much improvement when we look at a cumulative new highs, new lows measurements of for the NASDAQ. It was showing some improvement. Now it's been leveling off. Then seasonality, have a number of different ways to look at this. We're in February where the average return is 0, 53% of the time. So take a coin and flip it and you'll be about close there. But then when you look at November to April, this is the strongest time of the year with an average return of 7.1%, and it goes up 77% of the time. Now we're coming into the second half of February where you take the median 2-week returns going back to 1950 and they end up being negative. Then we look at the quarter here where nothing really to write home about as far as performance in the first quarter after an election. This is also put out by Stock Traders Almanac, just showing you the whole year, just to see. This is the last time I had this updated and what we were doing, and then different ways to measure this. I guess the takeaway would be that we tend to go up here, more or less. All right, and then the second half of February can be difficult. Doesn't mean it's going to be, but historically it has been. And then we look at February is a post-election year going back to 1950, split as far as up and down with a return here of minus 1.3%. Thank you. I really hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.